Hello everyone and welcome. I'm really glad to have you here today for another session in our Sustainable Data Management series, where we are deep diving into specific ESG methodologies with the providers that shape them and the market. Today we are excited to host Carbon4finance to explore their carbon impact analytics solution known as CIA. CIA is a comprehensive framework for measuring climate transition risk and carbon footprint across portfolios. Today we will cover the CIA methodology and how it is setting itself apart from other methodologies. We will cover practical use cases along transition risk, fund construction, and regulatory reporting. And a key element that we will touch upon is the coverage question. This methodology does not only cover corporates, it also deep dives into sovereigns, banks, and it proposes a complete new 2026 climate bond framework. The final point we will talk about is AI emissions and how these AI emissions are shaping materiality in the future, as well as the impact of the ESG rating provider regulation. If you have any questions as we go, please feel free to drop them into the chat. Our team will address them throughout the session. I am Matthias Breyer, Chief Product Officer of WeeFin. WeeFin is the market-leading sustainability data management platform, helping financial institutions to scale their ESG strategies from data integration across 50+ data providers into custom scoring, engagement tracking, and regulatory reporting. Our goal with this series is easy. We want to push the industry forward by sharing expertise, ours and the one of our partners. Joining me today is Pauline Aritignon, Senior Climate Methodology Expert at Carbon4finance, an independent and 100% French climate data provider with over 10 years of track record. Pauline sits at the heart of the CIA methodology. She is responsible for the development and the evolution. And today she will bring the precise expert perspective on the choices that underpin the solution and what that means for practice and for you. Thanks for joining us today, Pauline.
Thank you for having me.
It's great to welcome you here in our offices. We want to start straight into this, and we want to start to talk about the presentation of your CIA methodology. Carbon4finance CIA methodology includes many different indicators, including greenhouse gas emissions, carbon impact ratings, and temperature alignment. And that brings me to the first question around which indicators are distributed by Carbon4finance as part of that solution.
So, to fully grasp the value of these indicators, it is essential to look back at the origin of Carbon4finance. The carbon impact analytics methodology was developed in 2015 by the Carbon4 group. It capitalizes directly on the historical expertise on the consulting firm co-founded by Alain Grandjean and Jean-Marc Jancovici, the creator of the Bilan Carbon framework. Carbon4finance was built to address a critical market gap. We wanted to move away from strictly financial abstraction to reroute investments where they matter most, guided by physical data. The DNA of our solution relies on deep sectoral expertise and a bottom-up modeling. So, our solution does not rely on a simple single carbon footprint. Instead, it delivers a comprehensive suite of indicators that measure 3 pillars: an entity's past, current, and future contribution to the climate transition. These metrics are calculated at the activity level before being aggregated at the corporate level. So, the core indicators distributed by the CIA solution include induced emission in absolute and intensity, which is Scope 1, Scope 2, and Scope 3. It is the classical carbon footprint, but crucially, Carbon4finance always calculates Scope 3 emissions that are considered to be material and what matters the most, as they represent the vast majority of climate-related risks, since they account for 80% to over 90% of an entity's carbon footprint. So To make this actionable, we provide this data into both absolute terms and a dual intensity metric that is normalized by EVIC, which is aligned with the PCAF framework, and normalized by revenue, which is aligned with the TCFD standards. However, induced emissions are only half the story. That is why we go a step further to calculate emission saving. Carbon4 Finance was one of the pioneers to calculate this data, and it makes a direct link with the Pillar B of the Net Zero Initiative framework. We separate it into two physical realities. Reduced emission, which are the internal historical intensity improvement within a company's own operation, and avoided emissions, which are emissions saved when a company products replace higher carbon alternatives on the market. To tie this together, we use the carbon impact ratio, which is the ratio of saved emission to induced emission. This ratio answers a simple question for investors. For a given amount of induced emission, how much carbon does the company avoid down the line? It allows for immediate comparison between peers. Also, we have pillar ratings. So for each activity within a company, they are scored from 1, the best, to 15, the worst. Our current performance measures the immediate positioning among a sectoral peer group, but we know that a static snapshot is never enough. That's why we look backward with the past performance that track historical trends. And finally, we look into the future, after the past and the current, through a transition plan assessment. It relies on a qualitative grid analyzing 5 key criteria: strategic vision, transition investment, Scope 1 and 2 reduction targets, Scope 3 reduction targets, and climate-related governance. And all of these layers are aggregated into a CIA overall rating ranging from 1 to 5, which provides transverse comparability. And we also provide other financial metrics such as taxonomy indicators with the green share alongside our brown or fossil share. And as you mentioned, we translate all of this into our portfolio with a temperature alignment ranging from 1.5 to 2 degrees and above, which gives us a clear global warming trajectory.
That's extremely interesting, and I can see how your CIA methodology is quite comprehensive when it comes to covering different areas in that space. One of the key questions that our listeners and viewers usually have is, what's the actual impact and how can these data points and indicators being used in the climate strategies for financial industries?
Yeah, so currently financial institutions face a triple pressure. They must satisfy external regulatory requirements. They must meet the rapidly growing demand from their clients for sustainable investment, and simultaneously they need to de-risk their portfolio from the physical and macroeconomic risk due to the climate transition. Crucially, our metrics are designed with a specific philosophy. They allow financial institutions to identify, back, and support the companies that are currently and successfully transitioning their business models today. So we translate this philosophy into 6 key use cases. So first, transition risk management. The CIA overall rating and our fossil and brown shares, for instance, serve as an advanced proxy for risk exposure. A financial institution can easily identify companies, for instance, that will be vulnerable to upcoming carbon taxes, regulatory shift, changing market demand, or stranded assets. Second, smarter stock picking. Investors can use our ratings, data, or the carbon impact ratio to implement a best-in-class strategy. Third, thematic fund construction. For asset managers looking to market impact-driven or green funds, indicators like avoided emission can serve as a grounding investment guide for the construction of these funds. instead of relying on vague aggregated ESG scores. Fourth, there is a credit steering for banks. And fifth, there is the active stakeholder engagement. So institutional investors can also, for instance, use the decomposition of the forward-looking rating to analyze and by looking at specific gaps, for example, a lack of Scope 3 target, insufficient capex, and to set precise enforceable milestones during their engagement dialogues. And sixth, and finally, regulatory compliance, because we make it a priority to closely align with existing regulation to ensure our data is directly, immediately actionable. And this allows financial actors to effortlessly comply with frameworks like Article 29 in France or the European CSRD or SFDR or global TCFD mandates.
Thanks a lot for that. That is quite interesting. You mentioned a lot of the use cases that we hear from all our clients across the board. One element that you mentioned in your response was the topic of transition risk. And I would like to understand a bit more in what are the specificities that Carbon4finance's approach uses when it comes to that transition risk analysis.
When evaluating transition risks, most ESG data providers rely on corporate self-reporting and high-level financial correlation. Unfortunately, these methods have proved to be limited and often underestimated. Carbon4finance's approach is fundamentally different. Our transition risk analysis is built on environmental physics, physical corporate flow, and a deep, complete, independent recalculations. Because the levers of decarbonization vary drastically from one industry to another, our methodology is fully customized for each specific sector. We cover more than 70 activities through these tailor-made methodologies, ensuring our risk assessment perfectly matches the different physical reality for each business line. So first, our core is a bottom-up approach. Unlike standard ESG methodologies that may estimate carbon footprint based on sector-wide financial ratio, the CIA methodology operates primarily on a granular company and activity-level framework. Our analyst will collect operational and physical data from companies' public reports. For example, for an oil and gas firm, we will evaluate exact volumes of hydrocarbons that are produced, refined, or distributed, for instance. Moreover, we take into account multi-activity profiles because large corporations rarely operate in just one sector. And Carbon4finance dynamically splits a company's revenue across distinct activities, applying tailored sector-specific methodologies to each business line. But transition risk cannot be measured by a historical carbon footprint only. Indeed, a company operating in a highly carbon-intensive sector, such as automotive or utilities, might actually be a key player in the transition if it is actively displacing fossil fuels. That's why our transition risk analysis also include an evaluation of the forward-looking strategy of a company, analyzing its resilience. And now, while this granular bottom-up framework provides an unparalleled level of precision, activity by activity, we hit a practical constraint because financial institutions manage thousands of lines and they require broad, universe-wide coverage for their entire portfolio. So we refuse to dilute our scientific rigor just to achieve scale. This is why we developed a sophisticated parametric top-down layer that seamlessly extends our bottom-up expertise across the global market. We utilize more than 1,200 activity estimators that are derived directly from our bottom-up methodology. And when we expand coverage to over 45,000 companies, our top-down layers mirrors our bottom-up philosophy. So if a company provides a revenue breakdown, our estimators are applied proportionally to each specific business line. And this guarantees maximum analytic precision, even at a massive scale.
Thank you so much for sharing that. And you started to touch upon about how many companies you actually cover. Looking into that topic of company coverage, you also include private companies and companies located in a lot of different jurisdictions. If we go into more detail on that methodology, and we have these different regulatory reporting requirements for the underlying companies in mind, we often end up with a core principle of it might be easier to get access to scope 1, scope 2 data. When we talk about scope 3 data, it's really hard to access the underlying information, and you often are dependent on what the companies report. But if we look into that reported data, we often see that it's not reported. We see that we have a requirement for estimates and so on. How do you in particular cover and work with those scope 3 data sets, considering that it's quite unstable if we look into companies as of today?
Yes, this is a critical question because data availability is one of the biggest difficulties for sustainability finance today. So when you look globally, climate disclosure are completely variable. Some regions have like regulatory reporting and mandatory reporting, while others face drawbacks. At Carbon4Finance, we never take corporate carbon reporting at face value because we refuse to fall into the reported data trap. Why? Because unlike financial accounting, where companies have actual invoices or bank statements, carbon accounting is different. There is no meter on a company's roof measuring carbon in real time. All greenhouse gas data are mathematical estimates. Therefore, a company does not naturally know its carbon footprint better than an independent climate expert using objective physical data. And our database proves this. Out of thousands of companies analyzed, 63% report some scope 3 emissions, but only 36% report the categories that actually matter for their sector. So to fix this, we systematically recalculate scope 3. Our sectoral expert defines the material categories, creating a level playing field where no company can hide behind a selective reporting. And you mentioned a bit the fact that scope 1 and 2 is also more often available, which is true, but we also perform a mandatory recalculation for those, because our main goal here is to eliminate the market-based bias, which is a method that allows companies to lower emissions on paper by buying green certificates. So instead, we strictly favor the location-based method. We look at the actual physical electricity grid a company is plugged into, and in bottom-up analysis, our analysts compare and look at our calculated results, compare with company's report. And if the company's data is physically accurate and location-based, we keep it. But if it fails this check, our calculated data takes over. So in short, relying blindly on self-reported data exposes investors to massive greenwashing. So we try to anchor our methodology in physical reality so that we deliver data that is globally consistent, easily comparable, and immune to some local political shifts, for instance.
Thanks for that introduction on the scope 3 estimates and reported information. That is a key element, I think, that can also separate your data from other data providers. If we look a little bit further, we've seen that your solution started to extend its coverage into other asset classes, types of issuers, and securities. And specifically, carbon emissions calculations usually is highly dependent on the underlying issuer's activity and specialities. So if we look into that, we have significant differences across how we look into a sovereign issuer or into real estate. Now, where your methodology stands out is this wide coverage, including real estate, sovereign issuers, financial institutions, and as mentioned at the beginning, the climate bonds that you brought in 2026. So how does the solution apply to these different issuers and asset classes?
So, yeah, that's true. As financial institutions move toward portfolio alignment, as we talked about before, they cannot afford to leave blind spots. So what is important is that the underlying philosophy of CIA never changes. Across all asset classes, our objective is the same, to measure the true physical contribution to the transition. Every single model ends with a 1 to 15 comparable rating. However, the mechanisms and data input that exist must adapt to the financial and physical realities of each asset class. So, for banks, the solution fits the specific nature of financial intermediation, fully aligned with the GAG protocol and PCAF. So the main difference with corporate is Scope 3. For a corporate, Scope 3 is driven by supply chains. For a bank, Scope 3 represents its financed emissions that is calculated directly from its balance sheet. Moreover, in our banking model, future performance carries the highest weight. Why? Because the banking sector is currently in a prospective phase. Therefore, we heavily evaluate a bank transition policies and sector exclusion. Then we have sovereigns that you talked about. So for sovereigns, we apply CIA to over 150 national government and 50 local authorities. Here, we track two types of carbon data: territorial emissions, that are what is physically produced within a country's border, and consumption-based emission, which is the true carbon footprint of what citizens consume, including import, excluding exports. And to get the final 1 to 15 score in sovereign, we evaluate three macro criteria: fossil fuel dependency, carbon intensity, and the country's dynamic trends against international climate pledges. And with our 2026 framework extension, we introduced a dedicated methodology for climate bond. This is a parametric framework that relies on the Climate Bonds Initiative database and which focuses on the three highest issuance macro sectors, which are energy, buildings, and transport. This methodology introduced a major safeguard. The final rating is a 50-50 combination of the project score and the issuer CIA rating. We implemented this constraint because the environmental quality of a bond cannot exceed the strategic coherence of the issuer. A renewable project cannot fully compensate for a parent company with a high carbon strategy, and this is a powerful shield against greenwashing. So, does the solution diverge? Mechanically, yes, because we cannot evaluate a sovereign bond, a sovereign nation, the same way we evaluate an automotive manufacturer or a project-backed bond. But philosophically, no, because we normalize all outputs into a single framework to allow financial institutions to compare transition risk across equities, bonds, sovereign debt, and climate projects with a single, unique, coherent risk strategy.
Thanks a lot for sharing your insights on that. One of the key topics that is driving our industry today is the integration and use of AI products and models. And companies might increase their greenhouse gas emissions quite significantly over the next few years because they are building more dependency on those AI solutions. Having that in mind, it is possible that AI will potentially not materialize in the actual transition risk because a lot of companies have it integrated into their technology already today. So when we look into your methodology as Carbon4 Finance, do you plan to adjust the CIA model to account for increased use of artificial intelligence by companies across the world? And should a company, in theory, have a lower score because they are using AI?
This is a really interesting question because artificial intelligence is definitely driving a massive industrial shift. From a climate perspective, It represents an unprecedented surge in energy and hardware demand. Our position at Carbon4Finance is clear. We do not need to alter the fundamentals of our CIA model to account for AI. Why? Because our physics-based framework is already equipped to analyze it. AI is an innovative tool, but it cannot expect the laws of thermodynamics. Under the GHG protocol, there is no isolated category called artificial intelligence. Instead, it is AI emissions are physically distributed between scope 1, scope 2, and scope 3, depending on how a company uses the technologies. Running AI training phases requires massive electricity consumption, and because Carbon4Finance strictly enforces the location-based method we talked about before, any company running heavy AI workloads on their own company servers will immediately see a physical spike in their scope 2 emission, and they cannot hide behind green electricity certificates. For non-tech companies, scope 3 is where the majority of AI emissions sit. It comes from outsourcing AI through cloud computing platforms, as well as the upstream carbon of purchasing hardwares and chips. For the information and communication technology sector, the digital backbone that enables the AI revolution, we deploy a dedicated sectoral methodologies. So our analysts conduct a deep dive into a digital infrastructure. We look at proprietary data center, but crucially, we also fully integrate outsourced data center into our scope 3 calculation. Of course, this assessment depends on corporate transparency. Because our analysts are sectoral experts, if an ICT company hides its data center consumption, our model will trigger proprietary estimators to reconstruct the missing data. So to answer the second part of your question, yes, companies with extensive use of AI can expect their scores to drop, but only if their AI deployment is decoupled from a clean energy strategy.
Thanks a lot for all of that methodological insight. That is really interesting for our listeners to understand how your methodology adapts to these different issues, asset classes, but also how it is working towards potentially future challenges with AI. A key topic that we've seen across the market, specifically in the European Union in the last few years, was increasing regulation that is trying to push for more transparency within the data provider area. Considering that we are expecting certain changes, and we've seen a lot of methodological revisions with other data providers, as we're expecting that the EU regulation would also apply to the scores that you mentioned as part of the process, do you have in mind on can a user expect significant changes to your CIA methodology once the regulation is actually in place?
This is arguably the most critical milestone for our industry. And our answer for Carbon4Finance users is straightforward. No, you should not expect any structural change within our CIA methodology. In fact, this regulation is excellent news because the ESG rating market as a whole has suffered for years from a lack of transparency. This regulation does not force us to change. Rather, it validates the exact model we have been relying on since our inception. This comes down to two core pillars embedded into our DNA: total transparency and absolute independence. Indeed, at Carbon4Finance, transparency is our foundational philosophy. We have always shared the core principle of our methodology with our clients, and we have always provided them with unlimited access to our experts so they can understand, challenge, and compare our data. And the European Union is now making this level of disclosure mandatory for the rest of the market, and we warmly welcome it, because it will finally allow our clients to evaluate different ESG solutions on a level playing field. And because Carbon4Finance framework was built from day one on independent recalculation and structural transparency, our methodology is already fully aligned. So we view this as a perfect opportunity to reaffirm the strength and leadership of France's independent pioneer in climate and biodiversity data.
Thanks a lot for sharing that. That is quite interesting to hear that you're building on that transparency for the last few years already. Thanks a lot for taking the time, Pauline, and for coming to explain the CIA methodology with all the clarity. We've had a couple of interesting topics today. We had a deep dive into Scope 3 calculations, estimations, and reported data points. And we understood how the climate bond framework actually works in practice. I want to now thank all of you for joining us today for this session of Sustainability Data Management series. If you have any follow-up questions, please don't hesitate to reach out to our team. We are happy to help you. We will see you in September with the next episode of our series. Until then, take care.